Is Bitcoin an investment bubble? Is it like the tech bubble of the early 2000s or like the Dutch tulip craze a couple of hundred years ago? By the end of this episode, you will be able to figure out for yourself whether Bitcoin fits into the category of an investment bubble or not. Thank you for listening to this podcast. I know that if you're listening now, you are someone who cares about your future. You want to use your time wisely and invest your money wisely in the future as well. And I bet you work super hard for your money too, because if you didn't, you wouldn't really care about investing it. And I know that you want to invest it in something that preserves it for the future. I believe that Bitcoin is the best asset that we can save our money in, not as a get-rich-quick scheme, but as a way to preserve our economic energy going forwards for future generations. And I believe that you are the best person to look after your money, not a wealth manager, not a finance advisor who's going to charge you a load of cash just to look after your money. I believe you are the best person for that. And I know that after just listening to a few of these episodes, you will become better educated than 99%, not just the population, 99% of wealth managers and financial advisors in the world. So thank you. And just one more thing, if someone sent you this episode, that means that they like you. That means they want to connect with you. Maybe they want you to listen to this because they've already listened to it and they would like to discuss it with you and learn about this savings mechanism called Bitcoin together. They're trying to be nice to you. So say thanks, maybe share it with a friend. I hope you enjoyed today's episode. Guy on net's called Joel Bomgar. I think I'm saying his name right, and I love this video that he's done. It's called The 3 Characteristics of a Bubble, and it's a very short video. It's only about a minute long, and when I watched it I thought, I really want to dig into that a bit more. So in the classic Bitcoin ethos of don't trust, verify, I've spent a bit of time looking at what is a bubble, what are the characteristics of a bubble, and I've used Joel's video to kind of guide me into a bit more deeper research and try and make this for you and answer the question, is Bitcoin a bubble? So the thing that Joel says is there are 3 major characteristics of a bubble, and the first one is that there's a single cycle. So I'll put a chart up if you're watching the video now as well. It goes up super fast, hits a massive high, everyone gets excited, and then it crashes back down. And it doesn't really recover. And that happens in a very short time frame. That's the second part. The bubble, the boom and the bust happens in a very short period of time, and it normally takes between 2 and 5 years. That's the normal period for a bubble of an asset or a stock or anything in that nature. Maybe it's even of a commodity. It goes up in a short period of time and comes down in a short period of time. And that's over 2 to 5 years. The third thing about a bubble, the characteristic of something which is definitely a bubble, is that it always crashes down to the mean or below the mean. So if the chart's going up like this and it spikes up, it normally crashes down back to here, to this point. And it doesn't normally continue going up over a long period of time. So it crashes down to less than what it started at, or kind of an inflation adjusted amount, roughly the same as what it was before. So there are a bunch of different things that I'm going to talk about in this podcast that typify a bubble. And then we're going to look at Bitcoin and whether that sticks to some of the aspects of the bubble, these 3 things that a bubble has, and whether it doesn't. The first asset which everybody seems to know about, it's very popular to talk about, and it's quite popular to compare Bitcoin to it, is the Dutch tulip bubble, which happened in the 1500s towards the 1600s in the Dutch Empire. And this is at a period of time when Holland was the largest trading country in the world, one of the largest economies in the world at the time. And the Dutch guilder was very much like the US dollar at the time. It was the sort of strongest currency, the global reserve currency, although it wasn't really kind of designated as that, but people look back and say that it was. But it was a very, very strong economy. And Holland still has quite a good economy for such a small country, but at the time it was a global superpower. Tulips actually didn't come from Holland. They were imported from Turkey. And when they got imported to Holland, Dutch people went nuts about them, because what people don't really understand about it, they didn't know about it, and I didn't know this myself either, is that tulips were very rare. The colours had never been seen by people in Europe before. The segmentation of the flowers, and there are these ones called broken tulips, where they have the sort of flickery colours on the petals. They'd never been seen by anyone before. And what happened is the Dutch elites traded tulips and tulip bulbs as if they were art and sort of status symbols of wealth. Prices then soared as a result of this trading with each other to multiples of their actual value. A single bulb could cost as much as a house at the height of the tulip craze, and people were going absolutely crazy. Everywhere you went, ordinary citizens joined in with trading, farmers, blacksmiths, like everybody was borrowing money against their house, against their property from the banks to be able to buy tulips and speculate in the future price of tulips. So the other thing is that tulips were not actually replicable very easily. So one tulip bulb normally takes 3 years to mature into an actual flower. So people were speculating and buying tulip bulbs saying in 3 years time it's going to be worth so much money because that tulip bulb will then multiply, and I think underground it kind of multiplies into 3 tulips, I think, something like that. And people were speculating that as a result of that, they would be able to sell the 3 tulips for more than the price of the 1 tulip that they bought. This resulted in a massive bubble, and in February 1637, buyers disappeared. There was an auction happening in a town in Holland, and nobody turned up. That is the greater fool theory, actually in physical action. People kept turning up to these auctions and buying and selling the tulips until one day, nobody turned up and the auction hall was empty. That then spread through the whole of Holland, and people found out that no one was buying it. And within weeks, the value of tulips would crash from 90% from the high that they were at just a few weeks before, leaving a lot of people completely wrecked because they still owed the money they borrowed to the banks. Now, why that's a bubble, like we said at the start, there were 3 parts of a bubble. There was a single boom bust, so it went up super fast and came down. And it didn't go up and up and up and up and didn't continue running up. It actually just went up once and then came down, and tulips have just stayed roughly the same price, matching with inflation, since that time 400 or 500 years ago. The second thing is it played out just over a couple of years. So it didn't take decades for these prices to go up, and it wasn't a gradual rise. Just over a few years, the price of the tulips went up massively. The third thing is that prices have never recovered since then. That's the 3 phases of a cycle, and I think we can definitely say that the Dutch tulip bubble was in fact a proper asset bubble. The tech boom of the mid-90s and subsequent bust is one of the most famous bubbles that we know about in our generation in recent memory. New internet companies popped up the whole time, often having .com in their name, sometimes not having anything to do with the internet or even having any idea what the internet was for. And these companies lived off the fact that people were on a hype for the internet. The internet was around, it was starting to be adopted, and people realized that something about this was going to change the future. And it did, obviously. We're here on the internet, it's changed the whole world. We know that now. But a lot of these companies raised millions, sometimes billions of dollars, and they had no real route to profitability. And that caused people to invest in them aggressively, thinking they were going to make millions and billions of dollars, but actually they were not really going to. One example is pets.com. This website wasn't even a website. It didn't do anything. It just was the name of a company claiming they were going to sell pet products on the internet, which obviously in the future became a big deal. But at the time, they had no real way of delivering these goods, showing these goods, taking payment for these goods. They just raised loads of money. They had a really famous sock puppet mascot, but they had no profit model. Another example is Webvan, in a similar webvan.com, similar company. They were going to do grocery delivery on the internet. And we know that now, only in the last 5 or 10 years, has grocery delivery actually been a thing which can happen. Even most grocery deliveries in my country, in the UK, you've still got someone going around the supermarket packing bags actually in the supermarket. It's only really Ocado that do it from a sort of a warehouse or an office that actually is a sort of tech business. But most of them are still not really operating like tech businesses, but they are doing online deliveries. But at the time, in 1995, there was no way of doing grocery delivery. There was no logistics able to do that. And that business eventually went dead completely along with the rest of the bubble. There was etoys.com, go.com, theglobe.com. All these companies claimed that they were going to dominate the world, dominate the internet, and sweep up all their competitors. As a result of that, the NASDAQ, which makes up most of the tech stocks, rose 400% in 5 years. Now, this is a slightly longer bubble, I will admit. It doesn't fully tick that short time period thing, but over the grand scheme of things, it did rise in a 5-year period and totally crashed in March 2000. Day trading exploded. People quit their jobs just to do day trading, and traditional companies that rebranded with .com didn't even do anything to do with the internet, and they just did it to boost their share prices. The NASDAQ fell 78% in the end, from its peak of 5,000 in March 2000 to 1,100 in October 2002. So a quick drop, and trillions of dollars were wiped out in wealth. Thousands of dot-coms went bankrupt, offices went empty overnight, but there are some survivors, obviously, but only a few. There were dozens and dozens of companies that were swept up in this bubble. The only ones that really survived was Amazon, Google, and eBay. They're pretty much the only ones. Maybe PayPal you could include there, but most of these companies went banging up, like Amazon went banging up. It also fell down to the mean, but only a few of them kicked the thing, which doesn't make it a bubble, which means that it continues to grow over periods of time, but the rest of them just died and never came back. Beanie Babies. Now, if you've not heard of these, you're obviously too young, but when I was a kid, everybody went nuts about these things called Beanie Babies. They're these sort of plush, cuddly toys that felt like they had a little beanbag inside of them. They had some little dotty polystyrene inside it, and they had a little tag on the ear, and no one wanted to take the tag off the Beanie Baby because it could be really valuable, because that's how you identified whether it was valuable or not. These sold between $5 and $7. That's how much they cost, really. And they were marketed with artificial scarcity. So they were made out to be like, we're only making 100 of these, or only making one of these, or we're only making 1,000 of these. And sometimes these were these sort of retired characters. They would make them for a bit and they say, oh, we're no longer making them. There were sometimes also some errors on the tags on the ears, which made people say, oh, it's very rare because it's got an error on the tag and it's not actually the correct tag for it. There was no advertising. It was all word of mouth. TY relied on collectors magazines and later eBay. And actually, at one point, 10% of all transactions on eBay were happening with Beanie Babies. That is crazy. So a huge, huge rush into the buying and selling of these Beanie Baby cuddly toys. Some Beanie Babies sold for thousands of dollars. The most one sold for was $3,500, and it was one called a Princess the Bear, honoring Princess Diana. Sold for $3,500. People began treating Beanie Babies as if they were investments. There were people on TV saying they've bought a stack of them for their kids' college funds. I mean, like at the time, these people were sort of in their right mind. But looking back now, you think, what were you doing? This is absolutely ridiculous. People insured their collections, and couples actually fought in divorce cases over the Beanie Babies. So they would settle and say, you have those ones and I'll have these ones, and you take the house and I'll take the Beanie Babies. Seriously, that was the thing. And there was a whole hype in the end in 1999 when the company TY decided to retire the entire collection in 1999, and the prices boomed up in a couple of months. And then after a few months later, they crashed completely back down to almost less than what they were worth in their manufacturing price. Eventually, no one wanted to buy them. They were worth $2, and 95% of Beanie Babies were completely worthless and were being sold in garage sales. Now, this again does the three things. There was a single cycle, it went up really fast and down really fast. It was a relatively short time period, in fact, a very short time period for this cycle, and it crashed back down to the mean. So eventually, even though they were worth thousands of dollars, they were eventually worth back to the average price of what they were, which was between $3 and $7. So I know some people will be asking, how is Bitcoin not a bubble? I've heard that the price goes up really rapidly, and even those people in Bitcoin in the community, we know that it's going to come back down again. But we know that it's not going to come back down to the mean. Bitcoin continues to rise logarithmically upwards. I'm going to put a little chart here of Bitcoin's logarithmically adjusted gains over the last 16 years since Bitcoin has been around. So if we look back at Bitcoin's prices, obviously started at about nothing, and it boosted up to about $32 in 2011. And yes, it did crash, but it crashed back down to $2, which is higher than the original nothing dollars. So that's how it would have been. If Bitcoin died then, maybe yes, you would agree that Bitcoin is a bubble. But it continued on. In 2013, it boosted up to $1,150 and then crashed back down to $200. Rising higher, like taking the mean higher than it was before. And then in 2017, we went up to nearly $20,000, actually $19,800. And then we crashed again, but back down to $3,200. That's $3,000 higher than the previous low. And then the final recent cycle went up to $69,000. And then not that long ago, we went back down to $15,000, and that was in 2021. And at the moment, we're moving up to a new all-time high of $120,000. So if that's the new peak, we would expect the new low to settle at around $80,000, which is still much higher than the previous low of $15,000. So in that respect, Bitcoin is not a bubble. it's definitely moving forward as a potential global asset. The three parts of a cycle, which is a single cycle, quickly up and quickly down, Bitcoin doesn't do. It doesn't go over a relatively short time period. Bitcoin has been going on for 16 years now. It's going to keep going. The longer it goes on, the less of a bubble it becomes. It doesn't crash down to the mean. That's the third part that Joel talks about. It crashes down higher than the mean and then continues to rise as we move forwards in time. So for all these reasons, Bitcoin is not a bubble, and I hope that has become quite clear now in this. If you'd like to talk about it more, hit me up, send me a message, leave a comment if you disagree with me. I would love to talk to you. I really want to learn more, so I'm totally down for some discourse.